Is your business growing faster than you imagined? Is your revenue higher than you ever thought was possible? Kudos to you. But it's time to stop leaving money on the table. I don't want you to pay more to Uncle Sam than you have to. So that's why today we're going to talk all about an S Corp. But don't get lost in jargon. We're going to break it down, simplify it. And I'm going to give you the sure signs that it's time to consider an S Corp for your business. So if the word S Corp is new to you, or maybe you're not confident in what that means, this is the video for you. All right, we are going to define what an S Corp is, and don't worry if that is like foreign lingo to you, we're going to break it down. We're going to talk about why it may be beneficial and save you a lot of money to become an S Corp. We're also going to give you some signs that maybe like now's not the time, because it's not just too good to be true. There are some like caveats or catches, but we're going to go over those. Then we're going to give you the key signs of when it's time to investigate this and when you should talk with your tax preparer about becoming an S Corp. And if you're like, who the heck are you? My name is Cheryl. My business partner Katrina and I own Empowered to Profit, where we help you put more of your revenue into your personal account, because otherwise, what the heck is the point of running this business? So simply put, an S Corp is an election with the IRS that determines how you're going to be taxed. Now let's talk about why this can be so cool. The biggest advantage of being an S Corp is not having to pay that self-employment tax, which is about just over 15%. If you are an individual or perhaps you're in a partnership, typically you have to pay that self-employment tax because you have not elected S Corp status. So if you elect S Corp status, you can avoid that. And while that sounds amazing and people would be like, well, why doesn't every business do this so they can avoid that self-employment tax? Well, let's break it down a little bit further. When you're an S Corp, it requires you to go on payroll. Now, don't lose me here. I know it sounds convoluted, but if you meet the criteria that we're going to talk about at the end of this video, it's worth it. So the reason why everyone doesn't do this is because you have to go on payroll as an owner. Meaning, for the majority of you, you are going to use a payroll provider, such as Gusto's our personal favorite, but you've probably heard of ADP, QuickBooks has one, don't use them. You have to use a payroll provider. They're going to submit your taxes on your behalf, just as if you're a W-2 employee, to the state and the federal government, and they're going to file all those reports. There is a cost associated with that. That's not a free thing to do. Of course not. So the benefit, that 15% you will save being an S Corp, has to outweigh the cost and the hassle of being on payroll. But that 15% can be a huge percentage. So yes, you will pay taxes as an employee on your wages that are going through payroll like we just discussed. But your distributions and the remaining profit of your business isn't taxed at that 15%. So I know this can sound like a lot, so let me break it down even further. Let's say you own a virtual assistant business. You are generating $150,000 a year in revenue, and you do a majority of the work. And you are considering becoming an S Corp so you can save that 15%. You are going to have to go on payroll, probably through Gusto would be my recommendation. If you need help with that, let us know. And you are going to take a reasonable salary. The next question is, Cheryl, what is a reasonable salary? Well, the IRS isn't going to tell you, but you have to be able to justify it in case you were ever audited. Typically, if you have a company, you are doing office work, administrative, and you're making around $150,000 a year in revenue, paying yourself $10 an hour probably doesn't make sense. You have to take a reasonable compensation. What would you pay an employee for that job function? And those varies based on your job function as the CEO and owner of this business. From there, those funds that go through payroll are taxed, just like a W-2 employee would be taxed. Where you find the win is any of the profits you take out of your business or distributions or money you use that does not go through payroll for personal reasons, that is not subject to that 15% tax. And that is why it can be really cool to be an S Corp. But as we just discussed, there is administrative cost to being on payroll, going through the headache of setting that up and administering that every 2, 4, 6 weeks, whatever your pay frequency is. And that's why there needs to be some key factors to make sure it's worth it. So I usually say my rule of thumb to our clients is once you're approaching around $75,000 a year in revenue, I didn't say profit, we need to start getting those wheels turning. Once you're taking a profit of over $50,000, $60,000, it's really time to consider when you should be an S Corp and have those conversations, because that could be a massive tax savings by filing with the IRS and electing to be an S Corp. So that is my rule of thumb. Like when you're generating around $75,000 annually in revenue, red flag, let's have the conversations. But I also want to remind you, once you elect S Corp status, you can't like flip-flop between being an S Corp, being a sole proprietor, being an S Corp. It's typically about a 5-year window that you have to stay this election. So we want to ensure that revenue is not just a one-off thing. I'll give you an example. We had a client who had a virtual assisting business generating great revenue year 1. Year 2, she wanted to pivot her services and offer something completely different, and therefore didn't generate the same revenue as year 1. In year 1, she elected S Corp status because in that year it made sense. Year 2, 3, it doesn't. So you need to not only consider what is your revenue today, but what is your trajectory of this revenue level. And when you can evaluate that, that's when we suggest you become an S Corp. Because while it may sound like a lot, it could be a massive savings.